हेलो फ्रेंड्स, वेलकम टू माय चैनल। दिस इज सीए राखी अग्रवाल। आज का हमारा टॉपिक है इंडियन अकाउंटिंग स्टैंडर्ड 109 107 32 which talks about financial instrument part 11. In the previous discussion we had discussed about the definition of financial instrument, financial asset, financial liability, equity. Then we had discussed about the difference between future and forward. Then we had discussed about the definition of derivatives and definition of options. We had also discussed about the measurement principles of financial instrument, like how to measure financial asset, financial liability and equity. What are the recognition criteria, how it is to be classified, what are the conditions for the classification of financial asset, financial liability and equity. Then we had discussed about the recognition principles, whether of initial recognition and subsequent recognition. Initially, we recognize financial asset, financial liability and equity at fair value. Subsequently, it will be recognized at a measurement which is recognized by its category. Then we had discussed about the some important benchmarking questions, like security deposits in case of rent, a loan given to staff, holding subsidiaries. If holding company gives loan to its subsidiaries, how it is to be accounted, how it is to be measured, in how it is to be recognized in these standards. Then we had discussed about derivatives, recognition principle condition need to be satisfied in case of derivatives, recognition principles, classification, all this in case of derivatives, in case of put option, call option, interest swap, in fixed to floating swap. Then we had discussed about embedded derivative. Embedded derivative is it's a hybrid contract where there is a host contract and there is a main contract, host contract and derivative contract. Yeah, derivative contract is hidden in the host contract. In case of embedded derivative, it is to be accounted as one contract, but there is a two contract, host contract and also the derivative contract. Two contract merged together in order to make one contract. Then we had discussed about the transaction cost, how it is to be accounted in case of financial asset, financial liability and equity. In case of financial asset, it should be capitalized with the value of the asset. In case of financial liability, in case of amortized cost, it should be reduced from the value of the cost. And in case of FBTPL, it will be charged to PL. Then we had discussed about transaction cost, how it is to be accounted in case of financial asset, financial liability and equity. In case of financial asset, it should be capitalized with the value of the asset. In case of financial liability, in case of amortized cost, it should be reduced from the value of the cost. And in case of FBTPL, it will be charged to PL. Then we had discussed about some important concepts like NCI put option, component evaluation. Then we had discussed about treasury contracts. Then we had discussed dividend accounting, offsetting of financial assets and liabilities, compound financial instrument, early redemption of compound financial instrument, conversion of compound financial NCI put option. All these concepts we had discussed in our previous discussion. Now we are continuing with the embedded transaction, some of the concepts related to embedded derivatives. Like in this today's discussion, we will discuss about some of the leftover concepts of embedded derivative, and also discuss about the impairment of financial instrument, like how we will account it for impairment in case of financial assets. So let's start our topic. Prepayment option. We had discussed various concepts of embedded derivative. Prepayment option is one of the concept of embedded derivative. Prepayment option in case of debt instrument. How it is to be, what is, firstly we will know what is prepayment option in case of debt instrument, in case of loan. Like prepayment means paid in advance. If any loan is to be paid in advance to the lender, then the lender will charge some penalty for early payment of loan. So that is the prepayment option. How it is to be accounted in case of debt instrument is also an embedded derivative, because in these there is a loan, simple loan, and also the derivative transaction is also there, because it should be a contract which is not paid today. So the condition of derivative need to satisfy in order to make it as embedded derivative. So prepayment option in case of debt instrument is a embedded derivative. How it will be, we will discuss. Like call option, put option in debt instrument is also an embedded derivative. However, such prepayment option, call option, put option are considered to be closely held with debt instrument. In order to become closely held, firstly satisfy the condition of closely held, exercise price of such option is approximately, in this case, when the exercise price is equals to amortized cost of debt instrument, then only it will be treated as a closely held. In this case, when exercise price is equals to amortized cost, it will be treated as a closely held option, and it will be not to be segregated, and also management will take the decision when. Now this concept is explained with the help of example, so it will be more clear for understanding. This is to be explained with the help of example. Suppose loan with prepayment option. Like in prepayment option, there is a host contract, means main contract is there, simple loan contract, along with a derivative contract. So amount of loan is suppose amount of loan is 1 lakh and period of term of loan is 5 years. Agreed coupon rate of loan with prepayment option. There is an option that if you will pay prepaid, then the percentage interest will be charged at 11%. Market rate of similar loan without prepayment option, means if they will not pay early, then the market rate is 10%. Market rate with similar option with prepayment option, means similar loan with prepayment option is to be charged at 11%. If they will pay early, then the some prepayment penalty will be charged by the lender to the borrower. 5 years period the term is. If they will pay in year 1, the penalty will be charged is 3169. If they pay in early in year 2, then they will charge 2486. If they pay early in year 3, then it will be required to charge 1735. And if they pay early in year 4, then they will charge 909. So per prepayment done, 1 लाख तो पे करना ही पड़ेगा, उसके साथ ये पेनल्टी भी लगेगा, बिकॉज इन केस ऑफ प्रीपेमेंट लोन के में जब आप बोरोवर, लेंडर एक कॉन्ट्रैक्ट पे बोरोवर को लोन देता है, अब बोरोवर उसको टर्म्स के पहले पे कर देगा, तो लेंडर उससे कुछ प्रीपेमेंट पेनल्टी चार्ज करेगा, क्योंकि उसका इंटरेस्ट का लॉस हो रहा है, उसके चलते वो उससे पेनल्टी रिकवर करेगा बोरोवर से लेंडर, तो वो यही वही पेनल्टी। तो आप जब बोरोवर जब लेंडर को पैसा वापस देगा तो उसके साथ पेनल्टी भी देगा, तो ये प्रीपेमेंट पेनल्टी है। प्रीपेमेंट के साथ अमाउंट ऑफ लोन और उसके साथ पेनल्टी भी वापस करें। नाउ इवैल्यूएशन ऑफ एम्बेडेड डेरिवेटिव। अब इस केस में हम लोग एम्बेडेड डेरिवेटिव को इवैल्यूएट करेंगे। कैसे? Evaluate whether the host contract and derivative contract is separated only, means only if it is separated if it fulfill the following condition. What are the 3 conditions? Economic characteristics of host contract and derivative contract should be of similar nature, would be of same or similar nature. जो characteristics है host contract और derivative contract का should be similar and same. The embedded derivative meets the definition of derivative which derive its value from its underlying asset. No initial payment is required and it is to be settled in future. An entire instrument is not designated to prevent accounting mismatch. Means the entire instrument is not designated to prevent accounting mismatch. Now analyzing point 1, firstly we will analyze because these three conditions is required in order to become an embedded derivative. So firstly we will analyze the point number 1. Economic characteristics of host contract and derivative contract should be of similar or same nature. Determine the amortized cost of loan. Some steps are there in order to analyze whether the host contract and derivative contract should be of same or similar. If the amortized cost is equals to, if the exercise price of such option is equals to amortized cost, then it is the embedded derivative and it is not segregated. So we will analyze, firstly determine the amortized cost of loan without prepayment option. If we will not pay early, then how much amount is required to, what is the amortized cost of loan? Firstly, we will determine that. Then we will compare the amortized cost with prepayment option, because here we had seen the options in year 1, 2, 3. What are the prepayment options are there? We will compare it with that. If step 1 is equals to step 2, the economic characteristics are similar. The economic characteristics are of similar nature, closely related, and hence in case of closely related and similar nature, no separation is required. Now in point 2, analyzing point 2, whether the embedded derivative meets the definition of derivative. We are analyzing the point 1 already analyzed. Then we will analyze whether it's meet the definition of derivative. Then we will find out the entire instrument is not designated to prevent the account. Now we will determine whether it's a derivative and embedded derivative in this transaction. Whether prepayment loan is a derivative. Yes, because in the above example it derives its value from the underlying asset. Yes, it's a derivative transaction because it derives its value from the underlying asset. In this case, the underlying asset is market interest rate, because market interest rate is the, in case of prepayment option, without prepayment option, and in case, yeah, it will be settled in future, because settlement happen after 5 years. Initial payment of these loan is nil. In this case, the host contract is the loan contract, main contract is the loan contract, and derivative contract is the prepayment option inserted, embedded, hidden in the contract. Prepayment option which is hidden in the main contract, that is the loan contract. Now we will make a calculation. We had already evaluated. Now we will evaluate the calculate the loan without prepayment option. If it is not prepaid, then how we will calculate the amortized cost? We will determine the fair value of the loan, that is 1 lakh, at the rate 11%, and we will make it at a present value factor. The coupon rate is 11%, and market rate with similar without prepayment option is 10%. So we will calculate without, if it is not prepaid, without prepayment option, we will determine the present value factor. The interest will be 11,000, because at 1 lakh ka 11% uska present value factor for 5 years. Then at the end of 5 years we will pay the whole amount along with interest, that is 1 lakh, uska present value for fifth year. So it becomes 103791. Prepare step 2, prepare amortized table. In year 1, the opening value will be 103791. The effective interest rate at the rate 10%, which is without prepayment option. Then coupon every year is, interest is to be paid 11,000 every year. At the end of year 5, it will pay 1,11,000, and the closing balance will be this. So opening pay interest at the rate 10%, which becomes 10,379. Coupon paid is 11,000. So opening plus effective interest rate minus coupon, the closing balance become 10317. Again it becomes the opening in the next year, and again interest is to be calculated, coupon is paid, and the closing balance is determined. In the same way, at the year end, the whole amount is to be paid and the closing balance becomes nil. So in this way we will prepare the amortization table without prepayment option. Now we will compare the closing value of amortization cost. That is, this is the closing value with prepayment amount which is given in the question. That is this. With the prepayment amount. Year 1, year 2, year 3. That is the closing balance which we had evaluated here. 103, 170, 10487. We will take this over here, and the prepayment option given in the question, we will compare these two. Now this difference is approximately 0. The difference is approximately 0, is equals, means the difference is more or less similar. 103 170 103 169. This, the difference is minimal, or it will we can say it is equal. So in this case, if the difference is the comparison, since the prepayment option and amortized cost is approximately equal, and thus economic characteristics of post contract and derivative contracts are closely related because they are similar. There is no difference arises in case of amortization cost and prepayment option. So they are similar in the amount is similar. So they are closely related, and hence no separation is required in this case. Because interest is foregone by the lender on account of early payment by the borrower, means on account of early payment interest lender का forgo हो रहा है, for which he has to pay penalty. Penalty इसीलिए borrower को पेमेंट करना पड़ रहा है lender को, for which he has to pay penalty to the lender for prepayment which is linked with the market rate, and hence prepayment option and host contract are economically closely related and thus not separate. Now the accounting entry, how we will account in the books of borrower. जैसे कि borrower ने पैसा लिया तो बैंक अकाउंट डेबिट टू लोन 1 lakh. Loan includes prepayment option, does not require separation. In this case, no separation is required because in case of no separation, full amount is to be disclosed. In the books of lender, no separation is required as the contract is a financial asset. Lender के लिए वो financial asset है, hence treat the same as a single financial asset. In case if separation is required, then how it is to be accounted? Loan without prepayment option, as we had calculated the amortized cost 103,791. If loan is without prepayment option, and in case if loan is with prepayment option, then loan with if segregation is required, then without prepayment option is this, any balancing figure is to be charged to prepayment option, like accounting entry in case of borrower book. This is in case when segregation is required, then this prepayment amount is the derivative asset. Loan without prepayment option account 10379, means this prepayment option is segregated with the value of loan. Bank account debit the amount of loan, derivative asset, that is the prepayment option, account debit to loan without prepayment, that is 1037. Loan includes prepayment option which requires separation. This accounting is in case of separation, if separation is required, and bank account debit to loan if separation is not required. That is only the amount of loan, no required to make an entry of separately the derivative. Illustration 2. In this illustration, entity X Limited borrows rupees 100 crore from Y Bank on 1st April 2023. Interest is payable at the rate 12% per annum, and there is a bullet repayment of principal at the end of the term. Term of the loan is 6 years, and the loan includes an option to prepay the loan at 1st April each year. Means loan includes an option to prepay the loan at each financial year, that is on 1st April 20. Every year the loan is repaid, means prepayment option is there to prepay the loan each year on 1st April with a prepayment penalty of 3%. There are no transaction cost. Without the prepayment option, the interest rate quoted by bank is 11% per annum. Discuss the solution. Solution. Firstly is step 1. Identifying the host contract and the embedded derivative. In these, the host contract is loan without prepayment option and embedded derivative, that is option to prepay. That is, there is two contract involved in one transaction, that is host contract is there, that is main contract, that is simple loan contract without prepayment option, and derivative is the option to prepay, means the penalty option. If the borrower pay to the lender before the term period, they have to pay some penalty for that. So that is the option to prepay, is an embedded derivative in this contract. Whether prepayment loan is a derivative, yes, it's a derivative, because in the above example it derives its value from the underlying asset, and the underlying asset is the market interest rate. The loan is the underlying asset on which the market rate depends, which is settled in future years. The loan is paid after the contractual period, that is the term of loan is for 6 years, so it should be paid after 6 years. And settlement, initial payment is nil or insignificant. Yes, there is no such payment initially. Or in these contract, in this case, host contract is the loan contract and the derivative contract is the prepayment option. Option to prepay the loan in before the term period is over. So that is the derivative contract, and the main contract, that is the host contract, is the loan. Now we will calculate in step 2 the present value of the loan without prepayment option. So fair value of loan is the amount of loan is 100 crores on which 12% interest the coupon is to be paid. उसको प्रेजेंट वैल्यू फैक्टर में एट द रेट 11% फॉर 6 years लाना है, और 100 crore is to be paid at the end of 6 years, that is the principal amount. उसका भी प्रेजेंट वैल्यू फैक्टर एट द रेट 11% फॉर 6 years, डिस्काउंटिंग फैक्टर डिस्काउंट करना. तो if we discount 100 crores at into 12%, that discounted by the present value factor 11% for 6 years, उसका present value plus 100 crores, उसका present value factor for 11% for 6 years, so it becomes 104.23 crores. Now in step 3 we will prepare the amortization table, that is in year 1 2 3 4 5 the amortization table is prepared. The opening balance is 104.23 crore. Effective interest rate is at the rate 11%, that is 104.23 into 11%, that is 11.47. Coupon is 12 crores. Closing balance is opening plus effective interest rate minus coupon, that becomes the closing balance 103.70 crore. These closing balance become the opening balance in the next year, and effective interest rate is at the rate 11%, that is 11.41. Coupon is 12 crores, and the closing balance becomes opening plus effective interest rate minus coupon, that is the closing balance 103.10 crores. In the same way, we will prepare the amortization table in the 6th year. It should be paid in full, that is 112 crores, and the closing balance becomes nil. Now in step 3 we will compare the amortization closing value with the prepayment option. In this case, the amortization closing value of amortization, as we had calculated in step 3, that is, this is the closing balance, and we will compare this with the prepayment option. It is mentioned in the question that every year 3% of the penalty, 3% of the outstanding loan is to be paid as penalty. So 3 crore is the penalty amount which is to be paid every year along with the principal amount. So if it is paid, if the borrower avail the prepayment option in year 1, he has to pay 103 crore. And in this case, the prepayment option is constant every year, that is the 3%. So in any year, if the borrower avails to pay the prepayment option, he has to pay along with the principal the penalty of 3 crores. So 103 crore he has to pay. So comparison of amortization closing value with the prepayment option, that is 103 crores every year. So the comparison is 103.70 minus 103 crores divided by 103.70, it becomes 0.67%, which is approximately equal. But as per the institute guidelines, if the percentage is 2% or more, which is the significant percentage, then it will be treated as that it is not equal, approximately not equal, and in that case, these are not closely related. As the percentage exceed 2% in the fifth year, which is significant as per the management assumption, and hence in this case separation is required in this case. So since prepayment option and amortization cost is approximately equal in all the 6 years except in year 5, because thus the economic characteristics of host contract and derivative contract are not closely related, because the percentage exceed 2%, which is a significant as per the management decision and as per the guidelines given by the ICI, that if the percentage exceed 2% or more, then it will be treated as significant difference, and these are not closely held, and it requires a separation. So in this case separation is required because the percentage exceed 2% in year 5. So the accounting entry in the books of borrower, in case if separation is required, loan without prepayment option is 104.23 crore, which fair value of loan, and prepayment option is the balancing figure, that is 100 crore is the loan amount and 4.23 crore is the prepayment option, that is the derivative option. So in this case, in the books of borrower, bank account debit will 100 crores, derivative asset account debit by 4.23 crore to loan without prepayment option, that is 104.23 crore. Loan includes prepayment option, which requires separation. Now concept of impairment related to financial instrument. What are the concept of impairment? Impairment is the reduction in the value of the asset. What is impairment? Impairment is in reduction due to value on the value of the asset, whether it's a financial asset or non-financial asset. Financial asset is covered under IND AS 109 and non-financial asset are covered under IND AS 36. So there is a separate standard for non-financial asset, that is for PPE, tangible, intangible goods, and also for goodwill. But for financial instrument, that is for financial asset like uh, trade receivables, for low lease receivables, for financial guarantee contract. For that, there is a separate standard, that is INDAS 109. So INDAS 109 provide guidance on impairment of financial asset, means creating a provision for doubtful receivables. Impairment of financial asset means there is a provision for debtors, provision for doubtful receivables. They had to make a provision for doubtful receivables, because financial asset means impairment of financial asset instrument means like in case of debtors, in case of loans, in case of lease receivables, in case of financial guarantee contract, in case of contract for unbilled revenue. So these are the scope for which the impairment of financial asset under INDAS 109 give us the guidance for that. Impairment is always recognized only for financial asset and not for financial liability. Impairment is discussed, there is a reduction in the value of asset only, there is no reduction in the value of liability. Impairment always happen in case of financial In case of asset only, there is a no impairment in case of financial liability. So impairment always recognized only in case of financial asset and not for financial liability. Now scope of impairment of financial asset under these standard under INDAS 109. Some of the financial assets are included under the scope mentioned below, like financial asset recognized at amortized cost or fair value through OCI. Lease receivables, loan receivables, then financial guarantee contract, guarantee given by the third party, then any contract for unbilled revenue under INDAS. Under INDAS 115, which is discussed in INDAS 1, what is unbilled revenue? The revenue which is earned for which the bill is not prepared. Means advance is received for which the bill is not prepared. Financial asset on which impairment provision does not apply. In which case, in which of the financial assets impairment provision does not apply? Like investment. Investment is a financial asset, like investment in equity shares. If you invest anything for on which the impairment provisions will not apply, which is recognized at fair value through profit and loss or fair value through OCI. Investment in debt instrument like debentures, on which the impairment provisions will not apply, or any other financial asset recognized at fair value through profit and loss. So, impairment provision will apply only on receivables, loan receivable, trade receivables, then on guarantee, financial guarantees, then lease receivables, then any unbilled revenue. Now, how we will do the accounting in case of impairment? Impairment is kind of expense, it's kind of depreciation. So it will be charged to P&L, impairment expense PL account debit to provision for impairment. And provision for impairment is reduced from the value of respective asset. This is to be explained with the help of example. Suppose there is a current asset under which the trade receivable is required and for which there is, we had created a provision because it's a doubtful receivable. So it will be reduced from the value of provision for impairment of trade receivable is reduced from the value of trade receivable and it will be reflected under current asset. And that expense, that provision will be treated as an expense, impairment expense, and it will be charged to P&L. Now, approach of impairment provisions. There are two approaches. How we will make an impairment provision? What are the approaches? Approaches of impairment provisions are two approaches. There is a general approach and another is a simplified approach. In general approach, provision for impairment needs to be recognized on the basis of credit risk of the trade receivable. Means in general approach, provision is need to be recognized on the credit risk of the trade receivable. Company is supposed to monitor the credit risk. How much credit risk is there? Company is required to monitor that. But in simplified approach, provision for impairment need to be recognized based on aging of financial assets. Like aging, like 0 to 6 months, 6 to 1 year, 1 to 2 years, 2 to 3 years, 3 to 5 years or more than 5. In these way the aging criteria is there for which the provision is to be recognized. And the company is supposed to monitor credit risk. Provision is required as lifetime of ECL. What is ECL? ECL is expected credit loss. Provision is recognized as lifetime expected credit loss. How much expected credit loss is there for which the provision is required? In general approach, there is a three methodology consists of provision for impairment in general approach. In simplified approach, they will recognize the provision on the basis of lifetime expected credit loss, but in general approach, they will recognize the provisions in three types. That is 12 months expected credit loss. What will the company will suffer loss in the next 12 months in the lifetime of the expected credit loss, or if the lifetime expected credit loss minus financial asset if impaired. There is a three methodology. What is rebuttable presumption? If the debtor has not paid its dues for more than 30 days, then it is assumed that credit risk is increasing. Means if after 1 month there is a credit period of 1 month, and if the debtor is not paying the dues within 30 days, then we will assume that there is a credit risk in these debtors. The assumption is minimal assumption is 30 days, but it will be decided in the contract whether 45 days, whether 60 days, or how much period they will decide, the management will decide. General model of financial asset. In case of general approach, like we had discussed in general approach, it will be dependent on the credit risk of trade receivable. Suppose by monitored risk, credit risk, the methodology consists of three, that is 12-month ECL, lifetime ECL, and lifetime ECL minus financial asset if impaired. Now, the expected credit loss. In case of what is expected credit loss in stage 1, stage 2, stage 3. Stage 1 is 12 months, stage 2 is lifetime, and stage 3 is lifetime minus financial asset impaired. So expected credit loss in stage 1 is gross receivable into probability of default. How much probability that the debtor will not pay? How much probability is there that the debtor will not pay? Total receivable minus multiplied by the probability of default in stage 1. Interest income, that is gross receivable into effective interest rate. Credit risk is decreasing in this case. And in stage 2, the how to determine expected credit loss, present value of future credit loss. आज से 5 साल बाद हमको कितना लॉस होगा उसका प्रेजेंट वैल्यू निकाल, वो आपका एक्सपेक्टेड क्रेडिट लॉस होगा. इंटरेस्ट इनकम इज ग्रॉस रिसीवेबल मल्टीप्लाइड बाय इफेक्टिव इंटरेस्ट रेट. और इन स्टेज 3, दैट इज द फाइनेंशियल एसेट इम्पेयर्ड. कितना फाइनेंशियल एसेट इम्पेयर हुआ, that is the gross receivable minus financial impairment into effective interest rate. Then we will determine the interest income. In stage 1, the credit risk is in decreasing trend. In stage 2, there is no such mention, but in stage 3, the credit risk is in increasing trend because impairment is there, so credit risk is increasing. Now scenario. Stage 1, there is no scenario. Stage 2, expected breach of contract by other party. In stage 2, if the contract is breached by other party, expected that debtor will facing financial difficulty and expected debtor become bankrupt. In which scenario the ECL is to be, means the provision is to be prepared. In stage 1, there is no such scenario mentioned. In stage 2, the scenario means if the party breach the contract, so there is a the requirement of provision creation is required. When the debtor will that the company know that the debtor is not able to pay because he is facing the financial difficulty, and if the debtor become bankrupt, in that case the provision is required, provision for impairment is required. In stage 3, when the debtor breach the contract, when the debtor is facing financial difficulty and debtor is become bankrupt, in that case the provision or impairment of provision is required, because if the debtor will not payable, debtor will not able to pay due to financial difficulty, due to bankruptcy, due to for which they breach the contract, in that case the provision for impairment on the financial asset is required to be prepared. Company has an option to apply general approach in case of long-term receivable which consist of significant financing arrangement. सो कंपनी के पास आपकी ऑप्शन है कि वो जनरल अप्रोच भी फॉलो कर सकता है, सिंप्लीफाइड अप्रोच भी फॉलो कर सकता है, बट इट इज अ बेनिफिशियल फॉर लॉन्ग टर्म रिसीवेबल्स दैट दे विल फॉलो जनरल अप्रोच which consist of significant financing arrangement. Now simplified approach means debtor aging process like 0 to, as we had said, 0 to 30 days, 30 to 60 days, 60 to 90 days, 90 to 180 days and 180 to 360 days. In these way the aging is to be done. Trade receivable is 1 lakh, 1 lakh, 2 lakh, 3 lakh, 5 lakh, any amount, and the provision is 1, 2, 3, 4, 4, 5, 10% the provision, percentage of provision, and the provision for impairment, if 1% provision is there, then it become 1 lakh into 1%, which become 1000, 1 lakh into 2%, then it become 2000. In these way the provision is to be prepared depending on the percentage of provision. These are the simplified approach which depend on the aging. Calculation of amortized cost considering impairment, if any, like in general way, what is the opening balance, we are added the transaction cost, added the interest, reduce the collection, reduce the impairment, or by ECL approach, expected credit loss. Now expected cash flow, how we will calculate the expected cash flows in case of uh, impairment, that contractual cash flow, whatever the contractual, the cash flows is there, what contract is prepared for cash flows minus amount expected to be realized, amount expected to be received, that is the expected cash flow, the present value of shortfall in receivables. This is in case of long-term receivable, like what are the formulas of expected credit loss, like ECL, that is expected credit loss. The formula for ECL is expected credit loss equals to EAD. EAD stands for exposure at default, means exposure which the company has on its receivable. How much the company default in receivables. EAD stands for exposure for default into uh, LGD. LGD मतलब loss given at default. The formula for LGD is 1 minus recovery rate. The formula for EAD is gross receivable minus collateral security. How much the receivable is there? How much the security is given by the debtor. And POD means probability of default. Present value of credit loss divided by gross value of receivables. So ECL is EAD into LGD into POD. EAD stands for exposure for default, means exposure which the company has on its receivable. EAD means gross receivable minus collateral security. LGD means loss given on default. LGD equals to 1 minus recovery date. POD means probability of default. Present value of credit loss minus gross value of. This concept is explained with the help of example. Suppose A Limited has given loan to B Limited amounting to rupees 80 lakhs for 10 years. A Limited given loan to B Limited for 80 lakhs for 10 years. The period is 10 years. POD is given, LGD is given, ECL is given. So POD is 0.40% for next 12 months. For next 12 months, probability of default is 0.40%. LGD means loss given on default, that is 32% of outstanding loan. Now ECL means EAD into LGD into POD. That is the formula for expected credit loss. EAD we will calculate, that is gross receivable, how much? 80 lakhs. Collateral security is not given. So 80 minus 0, it becomes gross receivable multiplied by LGD. LGD means LGD is given in the question because LGD of outstanding loan, that is 32%, and POD is also given for next 12 months, that is 0.40%, which becomes 10,240. 80 lakhs into 32% into 0.40% becomes expected loss becomes 10,240 rupees. Now the journal entries, these amount is in the impairment loss. Impairment expense account debit to provision for expense. That is 10,240 impairment expense to provision for expense. Now illustration 2, this example is related to aging bracket, that is the simplified approach. Previously we had discussed about the general approach. The example is related to general approach. Now we will discussing the example of simplified approach, that is the aging brackets. The approach related to expected credit loss provisions in case of simplified approach where aging brackets is given. Now O Limited, which O Limited manufacturer has a portfolio of trade receivables of 40 millions in 2024 and operates in India and USA, and the customer are large number of small clients, and trade receivables are characterized by common risk that are representatives of the company's ability to pay all the amount due. The trade receivable does not have significant financing arrangement. In this case, the trade receivable does not have a significant financing arrangement. Aging bracket is given 0 to 30, 31 to 60 days, 61 to 90 days, more than 90 days. Trade receivable become 70 lakhs, 1 lakh 40 lakhs, 1 crore 40 lakhs, 60 lakhs, and more than 90 days between 1 crore 30 lakhs. POD probability of default is given 0.35%. Impairment loss is 24,000. Means 70 into 0.35% becomes 24,500. In the aging bracket 31 to 60, there is a trade receivable of 1 crore 40 lakhs. The probability of default is 0.5% and the impairment loss is 1 crore 40 lakhs into 0.5%, which becomes 64,400. 61 to 90 days का bracket में trade receivable is 60 lakhs and probability of default is 0.4%, which become the impairment loss is 21,000. And more than 90 days, the trade receivable is 1 crore 30 lakhs. Then the probability of default is 0.7%, which becomes 1 lakh 30 into 0.7%. That is, the impairment loss is 85,800. The total trade receivable is amounting to 4 crores, that is the 40 millions. The impairment loss on these is 1 lakh 95,700. The journal entries will be, in this case, impairment loss is account debit 1 lakh 95,700 to provision for impairment. These provision of for impairment is reduced from the trade receivable, that is 1 lakh 95,000 to trade. Illustration 3, that is Bank D Limited has given loan to segment X and segment Y. That given loan to segment X and segment Y, that is the gross carrying amount 2 lakhs. Transaction cost is 0. Net carrying value is gross carrying amount minus transaction cost becomes net carrying value. Number of defaults in these is, in segment X they will not able to pay the 4 installments, and in segment Y they will not able to pay the 2 installments. Amount of loan is 200, so total amount of default becomes 4 installment. Number of default, probability of default is 4 and the amount of loan is 200, so the total amount of default becomes 4 into 200, that is 800. In segment Y, the probability of default is 2 and the amount of loan is 300, so 2 into 300, that is 600. Gross amount of default, that is 800 in segment X, and in segment Y the probability of default is 600. Present value of loss already given in the question, that is 600, and in segment X and segment Y 450. Now calculation of loss rate, how we will calculate the POD, that is the present value of credit loss divided by gross carrying amount. Present value of credit loss is already given in the question, that is 600. Gross carrying amount is given in the question that is 2 lakhs. 600 divided by 2 lakhs, that is 30% is the loss rate. That is probability of default. In this case, we have to calculate the probability of default. So gross carrying amount is already given in the question. That is 2 lakhs in segment X, and segment Y, that is 3 lakhs. So calculation of loss rate, that is probability of default, that is in segment X it becomes 30%, and segment Y it becomes 15. We have discussed today's topic. In the next session we will discuss about the concepts related to derecognition of financial asset, financial liability, and some disclosures. I hope we will able to complete our financial, these standard 107, 109, 132. Though it's a long, lengthy standard, but somehow we are managed to complete this standard in a better way. I think I managed, I built to make you understand these concepts in a proper way. Thanking you for watching my video. If you like, please share, subscribe my channel.